Welcome back to the Investor Professor podcast. This is Dr. Ian Peckham, and this is episode 74. On today's episode, Bad Blood. We're going to talk about all the financial crimes that seem to be going on all around us. FTX implosion, Elizabeth Holmes being sentenced, and, look at maybe some of the similarities between these and some of the ones that have happened previous to this. And kind of how do we protect ourselves from this kind of catastrophe within our portfolios, and maybe what are some warning signs to look for. So I hope you'll join us on the other side. Get your mind right. Let's get to work. Okay, well, welcome back to the show, everybody. Before we start talking about all the criminality going on in the finance world, we'll just discuss what happened in the market this past week. So, most of the companies have reported earnings. They've been okay. I don't know if it's been kind of a mixed bag. Some have been horrible. Some have been good. And you really see that when you start seeing this economic conditions start to crack, pretty much. And so you'll see like the guidance on some companies is very weak based on kind of what they're seeing with the consumer. And so we kind of get into this no man's land where we're approaching the end of the year, and we're also approaching the next Fed meeting, which is the spotlight is going to be on that, which is December 14th, I believe, 14th, 15th. And so you have a lot of the Fed presidents around the country that they're getting interviewed by different news outlets. All those, I think there were 16 interviews this past week, which is a ton. And so you'd have one Fed president come out and say, hey, I think inflation is getting under control. I don't think we have to raise as much as we maybe previously thought we would. And so you'll see the market go up. And then the next day, you'll have another president who says, I don't think we've raised enough. We're going to have to keep raising rates. And then the market goes down. So every day you go up 200, next day you drop 200. And it's just this seesaw action between which Fed presidents are being interviewed and where. So there is a blackout period a week before they meet. None of them can talk to the press. And so then you normally kind of get some normalization, but it's just kind of amazing to see how polarized the market is to the Federal Reserve. And so again, we're looking here to see, is there going to be a pause in the interest rate hikes? I think that in December, you'll see 50 basis points. They're going to meet in January. It's probably going to be 25. And then if everything's looking well, maybe they'll pause in March. They don't meet in February. So we'll see how that ends up. It's going to impact how people invest and how aggressive they are with their investing. And just to kind of bring this point home, you'll notice that when the Fed talks about not having to raise rates as much, the NASDAQ is the index that goes up the most based on that news. And that's because that's where all the tech companies are, and they're more impacted by lowering of interest rates or keeping them where they're at, because a lot of you're talking about the future profits of a company, and I've discussed this before, but when interest rates go higher, it makes the future profits of a company worth less today. So if they don't have to raise as far as people were, or if they don't have to raise rates as high as people thought they were going to have to raise them, then the profits of those technology companies are actually worth more in the future, not less. And so you'll see the NASDAQ really rise on that news. And because so many technology companies have been absolutely pummeled this year, you kind of get an aggressive correction to the upside, which is what you'll probably see. If the Fed stops raising rates next year, and if at some point they actually start to lower them, I'm not sure that'll happen. We're way too early to be talking about that. But if that were to happen, you would see the NASDAQ have a very good year next year, simply because the profits of all those companies would be worth more. But really, in this kind of environment, it shows why it's so important to have kind of a diversified portfolio, because when the technology stocks fall, you get the staples and they start to go up. So the companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, which I'll spend some more time talking about kind of some ideas, investment ideas for 2023 in a future episode, because there are some companies that look to be kind of setting themselves up for a lot of success. Johnson & Johnson being one of them as they look to split. So, but this week's episode, Bad Blood, we're going to talk about some of the financial crime that's happening out there. And I wanted to cover this Theranos, which is Elizabeth Holmes, who was sentenced to a little over 11 years in prison yesterday for defrauding investors. Now, of course, she was sentenced to 11 years. I'm not really sure how many she'll serve. But, you see this, and there's a book that was written on this called Bad Blood, which is basically the story of Theranos. And now it's I believe it's a show on Hulu called The Dropout. I don't know if it's on Hulu. Hold on. Yes, that's correct. It's on Hulu. So you can watch The Dropout, which is the story kind of based on the book on Bad Blood, but talking about Theranos and how she did this, and they defrauded investors out of $9 billion. And so, not saying that I'm happy that she got sentenced to prison time, but when you look at some of the financial crime over the last 20 years, especially if you go back really starting with kind of Enron, you look at that, and the Enron guys kind of got off relatively easy. And so financial crime has been much more scrutinized and highly publicized, especially when you look at Bernie Madoff, who actually died in prison a couple years ago, sentenced to 150 years for that Ponzi scheme. And so you look at this, so Theranos, $9 billion versus Bernie Madoff at $50 billion. They estimated that Enron defrauded investors of $23 billion. And so these become very important because investors have to know that the system that they are investing in is a level playing field, that people aren't trying to defraud them. But we all know that everywhere there's going to be somebody who's doing something that is probably not in the best interest of investors. And so it becomes very worrisome for many people about, am I investing in things that are actually worthwhile, and are these real? And, every time I read about one of these, or I see an FTX or a Bernie, a Madoff, all those, I always think about, like, I know, there's somebody else doing it somewhere, but they just haven't gotten caught yet, or maybe they're still getting away with it. But if you look, like most of these that have gotten, they've unraveled, the best time, or, most of the time that these get unraveled is during times of financial distress, when the market isn't doing well. And as Warren Buffett says, you don't know who's swimming naked till the tide goes out. And so, when financial distress happens and asset values fall, then those that have been pumping up those asset prices and doing things they shouldn't be doing, they just can't do it anymore. It just becomes a house of cards, and it just collapses around them. And so you look at, this FTX and how quickly it's starting to grow, and you start finding out every day there's more people who are finding out that they were linked to this and they didn't even know it. And so you even look at like the Ottawa teachers' retirement in Canada had 5% of their fund in FTX that they had to write down to zero. You look at, real businesses, real pensions that are taking care of real people that had ties to this, that, it impacts real people. I think sometimes you think of FTX and you think of just crypto investors, and maybe these are kind of the riskier investors on the fringe. But in reality, there were some pretty real pension funds, government funds that had investments in this for real people that were hoping to be able to retire off some of these assets. And so this happens because over the past, 15, 20 years, there have been so many endowments that have made so much money off alternative investments. So if you look at Harvard and Yale and kind of the big ones, right, they started going away from traditional investments and doing kind of private equity type investments, and they did very, very well. And so other endowments and pension funds have followed suit. And so for the most part, they work out. But then, of course, you get one like this that is just a spectacular implosion, and it really has an impact throughout the system. And so I thought it was, I guess, interesting. I don't know if that's the right word, but the CEO of FTX, which I discussed last week, is the same man who handled the Enron debacle. And he came out this week and said this is the worst the worst piece of financial, engineering or just absolute carnage of financial, just not knowing what you're doing, just craziness that he's ever seen, which coming from the guy who handled Enron, that has to count for something, I would think. And actually his direct quote was, he's never seen such a complete failure of corporate controls and a total absence of trustworthy data and lack of financial safeguards. That was his direct quote, which is not good, meaning that they're even going to have a hard time tracking where all of this went and what happened to it, and it's going to take quite a while. So you look at, when you have a huge collapse like this, right? Everybody wants somebody to blame, and so you look at some of the lawsuits, and even some of the athletes that were spokespeople for FTX have actually been named as, defendants in these lawsuits. Shaquille O'Neal, Tom Brady, some of the big name ones. And so, it goes back to what kind of investor protection should be there. Well, I remember a year ago, some of these crypto companies or whatever, if you put cash with them, they would pay you between 8 and 12% on your money, right? So, and to me, that was a huge red flag, because it's like, okay, how are they going to pay me 8 to 12% when everybody else is paying 0? Like, how does that work? And so these are just some of those things that you need to be a little bit skeptical of. But most, I would think most investors, especially most retail investors, that's not going to be a normal red flag for them to pop up. They're going to be like, wow, I can make 8% and my savings account's paying 0. Why wouldn't I do it? Right? They're going to think, why wouldn't I do that? Where if it's somebody who's in the business would be like, man, how you pulling that off? Like that, because the interest rates are set by the Federal Reserve, like all the things we discuss. And so, but for most retail investors, they're not really going to be thinking like that if their friends are doing it. It's one of those things. There's nothing that bothers somebody more than seeing somebody that they know that they don't think is very smart, who's making a lot of money, and they're like, how's this person doing this and why can't I be doing that? Right? And so when there's a little glimmer of truth and, you get, enough people to start doing it, I mean, that's when these things really take off. And so it was the same thing with Bernie Madoff. I know I discussed it on an episode before, but he did every year his returns were like 12.5%. And the only problem with that is that they were like 12.5% for like 15 years in a row, which is basically mathematically impossible. But yet somehow he was able to do it. And so because he was able to do it year after year, people stopped questioning and were like, well, I'm going to take my 12.5% and I'm going to be happy with it. And then all of a sudden it turns out that those weren't true. And so you have to be, it's kind of the old adage we hear, right? If it's too good to be true, it probably is. But we just don't really think about that happening with our finances or things that are going on. And we do have so much regulation in so many areas of the market that sometimes it kind of makes our guard go down because of that. And so with FTX, there's not a lot of regulation in that arena right now. And so you do have to be careful, and there's already talks of some of these others that might be looking to, the next domino to fall, crypto.com, different ones like that. I mean, we'll see, but it's definitely going to set these companies back a ton. Congress is trying to interview them. So we'll see if that happens, if they show up. Man, just a soap opera right in front of our eyes. These kind of events bother me because I know that like when these kind of events happen and trust is lost in the financial system, there's so many who will never trust it again and they won't invest. And I touched on this a little bit last week, but I mean, it really does matter because there will be, younger people who are maybe in their 20s that lost a ton of money and they'll never invest again. And that's horrible. I mean, that is absolutely horrible because it's really going to impact their future. And, you shouldn't let it do that, but you do have to protect yourself. You have to, use that brain of yours and say, man, does this sound too good to be true? And also to diversify, that's why diversification is around, so you can diversify the risk. Now, the problem with FTX is that it was an actual exchange. So people, they might not have been in the FTX coin, but they were using their exchange to invest in other things, which makes it that much more dangerous. Now, just to kind of put your mind at ease, if you're a retail investor and you're on a platform like Schwab or TD Ameritrade or Fidelity, there's something called SIPC, which is insurance, kind of like FDIC. So SIPC stands for Securities Investor Protection Act. And so it covers your account up to $500,000. And most of the exchanges that you would be trading on have additional insurance that covers you for even more. So that is the protection that is out there for different exchanges that are regulated, that are kind of backed by these insurance measures. So checking for things like that makes it to where you don't have to worry as much. But that's not something that these exchanges, these crypto exchanges were able to offer because they're not regulated. So all of this kind of comes full circle to that on investor protection. So, we'll see how this story ends up. And hopefully we'll get to talk about some more, good things that happen. But again, I mean, when you have market downturns, when you have bear markets, if you look at the last 3 big bear markets we had, which would be right now, 2008, 2009, tech bubble bursting, there was some financial crime in every single one of those. And again, it's normally when asset values drop like this that somebody who's not doing things the right way they're going to get exposed because of that, because they can't hold it up anymore. And so it kind of cleanses the system, if you will. But it's also not good to see, not good for people to see their values go down, their portfolios drop. But again, if you're investing in good companies, strong companies, good balance sheet companies, I mean, this is a great time for you to be able to add more shares of good companies that you think are going to do well over the next 3 to 5 years. So take that lesson instead of the lesson of I shouldn't invest in the financial markets at all because they're all cheats. They're all trying to, take things from me. Anytime you're working in a business, no matter what that business is, if there is the ability to make a lot of money, there are going to be people who are trying to cheat the system. It's just part of it. I mean, that's, when you work in businesses where you can make a lot of money, like I just said, like there will be people who will try to figure out a way around it, to do it the wrong way. But you got to stay the course, do the things that'll help you be successful in the future, and things will work out in your favor. So I hope you have a great Thanksgiving week. We'll have a Thanksgiving episode, talk about what we're thankful for next week. So have a good week, everybody, and I'll see you next time.